Welcome back, everyone. In this fireside chat, we are pleased to be joined by Fiona Gillespie and Carmel. Fiona is macro strategist, assistant vice president at Swiss Re, and Carmel is a strategist and partnerships consultant for the Global Infrastructure Facility, an initiative from the World Bank. In this fireside chat, Fiona and Carmel will share with us insights from Swiss Re's latest report, Closing the Infrastructure Gap. Welcome, Fiona and Carmel.
Thank you very much. We're very pleased to join the Phenix Digital Impact Symposium for this fireside chat on mobilizing investments to foster the sustainable recovery of emerging economies. In the lead up to COP26, this topic is particularly timely, with public budgets constrained and government debt elevated to levels unseen before in the aftermath of the pandemic. It's important now more than ever to mobilize private sector capital to promote long-term resilience. So in this context, our two organizations, the Global Infrastructure Facility and Swiss Re, collaborated on a joint report entitled Closing the Infrastructure Gap, Mobilizing Institutional Investment into Sustainable Quality Infrastructure in Emerging Markets and Developing Economies. The report itself delves into the demand-side perspectives from the private sector, as well as the supply-side responses from developing country governments and multilateral development banks that should be taken into account to unlock greater private investment, particularly as countries recover from COVID and seek to meet the SDGs and Paris Agreement goals of transitioning to a net zero future. Specifically, the report outlines 5 concrete actions that investors and developing country governments can take, including expanding infrastructure pipeline development, promoting standardization of projects, increasing use of credit enhancement products, creating aggregation platforms, and enhancing ESG disclosures. So using this report as a point of departure, let's dig into some of the recommendations from the report and discuss some of the actions needed to mobilize institutional investment. So my first question to Fiona is on the climate crisis. So the climate crisis and the effects of COVID have highlighted the importance of aligning investments with ESG considerations. From the perspective of a global insurer, how should Swiss Re and other private sector players think about integrating ESG to ensure that it's not just an afterthought, but rather a driving force?
Sure. Thank you very much, Carmel, for the great question. And before diving into it, let me just start by saying that it is a pleasure to be here today and to be part of such a timely and important conversation and debate. So Swiss Re was one of the first reinsurance companies to integrate ESG benchmarks into our investment portfolio in 2017. And we are now even more convinced that taking ESG criteria into account has a positive impact on the performance of our investment portfolio in the long run. Our approach to incorporating ESG criteria into investment decisions is largely threefold. So firstly, the enhancement pillar, which includes the screening of potential transactions by considering the 3 E, S, and G dimensions. Secondly, the inclusion pillar focuses on themes within the infrastructure asset class. This would be a strong focus on renewable energy and also social infrastructure. And lastly, the exclusion pillar ensures that we avoid those less ESG compliant investments, such as those that are coal intensive, for instance. But if we want to meet the Paris Agreement targets, it is primordial that long-term investors such as ourselves adopt and adhere to such sustainability frameworks to ensure ESG factors are rigorously analysed to facilitate more informed due diligence processes and also investment decisions. But simultaneously, beyond what us as investors can do, emerging market and developing economies must also support the private sector if they want to attract some of the available capital. They can do so by deepening ESG and climate-related reporting standards and ensure that their approach to sustainability is aligned to the broader market. One way to achieve this at a more global level is to create more standardized tools that allow investors to more easily identify the ESG-ness, shall I say, of infrastructure assets. But so on this point, Carmel, if I turn to you, the GIF is similarly focused on promoting sustainability frameworks through its involvement with initiatives such as Fast Infra. Can you maybe expand for us on how such initiatives can support the sustainable infrastructure landscape in EMDEs and therefore help to boost the pipeline of projects available to investors?
Yes, absolutely. And as you raised earlier, creating standardized tools that can make it easier for institutional investors to direct financing into truly sustainable infrastructure projects is really key here. So Fast Infra is an excellent example of this. It's an initiative that the GIF, alongside other partners, have been leading to develop an investable class of sustainable infrastructure assets with the goal of creating a sustainable infrastructure label that will be attractive to institutional investors. And this label is based on 14 sustainable criteria along ESG and adaptation and resilience dimensions that will give investors comfort about the sustainability of the infrastructure asset itself. And while this is a really useful tool downstream when projects are brought to market, the SI label will also be really crucial upstream as well by helping governments select, prioritize, and design projects that incorporate sustainability considerations from the very beginning. And that really leads to my second point, which is the importance of improving pipeline. These standards, like the Fast Infra label, are really only as good as the supply in the market. And we often talk about the idea that there is this massive demand and resources from investors looking to direct capital towards infrastructure, but the supply is lacking here. And we've heard time and again that expanding pipeline is really crucial, but equally important is the need to balance quantity of projects with quality. And project preparation facilities like the GIF have played a key role here. We work through our MDB partners with governments upstream to prepare projects that are high quality, low carbon, climate resilient, going through technical, financial, environmental, and social due diligence, and structuring support to prepare projects that are bankable and commercially attractive to the private sector. And such efforts should really be scaled to create the deal flow needed for institutional investors to participate. But pipeline is just part of the equation here, which leads to my next question to you, Fiona. At present, investments in long-term assets such as infrastructure are complex, illiquid, and heterogeneous, which presents significant hurdles for many institutional investors. So how can the investment process be simplified and be made more transparent to attract more private capital?
Mm-hmm. So one of the main roadblocks that we see is that infrastructure as it is currently designed, planned, and also structured, is highly bespoke. So it incurs high transaction costs, and there are seldom replicable models that come out of these structures that can be applied in other emerging markets. So here, standardization of contracts, PPP frameworks, and also procurement documents, for instance, could help lessen these transaction costs. Standardization is perhaps the most important action to take if more institutional investor assets are to be mobilized for infrastructure debt, for instance. So in addition to what we identify in the joint paper with the GIF, Swiss Re also co-chaired the European Financial Services Roundtable initiative on best practices towards standardization and harmonization. And here, the four elements of the best practice standardization framework are really, so firstly, the disclosure and reporting requirements. And to this end, an industry standard template has been developed. Secondly, the debt terms and documentation are also key. And for this, a common governing standard would represent a good step towards harmonizing contract terms across jurisdictions. Thirdly, the information on administrative responsibilities such as cash flow and collateral management should also be captured. And fourthly, there should also be clear guidelines for the interaction and disclosure relating to third-party advisors. Now, such standardization would also be supportive for the aggregation of infrastructure assets. Platforms which securitize several smaller and or below investment grade assets into single pooled vehicle can improve the risk return profile and the overall financial attractiveness to institutional investors. So the potential for multilateral development banks to securitize infrastructure assets has already gained traction and has been brought forward as a proposal by the G20's Eminent Persons Group as a key driver to mobilize private investment. But while we're on the topic of risk return profiles, a key bottleneck to crowding in institutional capital into emerging markets is the issue of risk. So whether risks relating with the often long tenor of infrastructure projects, macro risks, political risks, and now more than ever, even climate-related risks. How do we overcome these bottlenecks to promote infrastructure as an asset class, Carmel?
Yeah, overcoming these bottlenecks really requires the creative use of financial instruments that can create risk-adjusted opportunities that best suit institutional investor preferences and risk appetite. And again, this is where MDBs and development finance institutions are really uniquely suited to play an important role. They often serve as intermediaries between governments and private sector investors and are able to offer risk mitigation tools and credit enhancement products that can cover a whole host of risks, including regulatory, political, and, as you mentioned, increasingly climate-related risks. And in the climate arena specifically, we're seeing entities like the climate investment funds work with MDBs and DFIs like IFC to co-finance blended finance solution in support of climate resilience and adaptation projects through guarantees, concessional loans, and investment grants. And the GIF is also similarly tackling this issue through the development of 2 blended finance facilities, both at the project level and the portfolio level, that aim to create de-risked opportunities for the private sector at scale. And these facilities are set up to offer liquidity to prevent defaults on payments, manage foreign exchange risk, and offer refinancing assistance to raise long-term commercial debt for infrastructure projects, primarily those that have been really hard hit by COVID-19. The GIF's portfolio level facility in particular will help to mobilize institutional investors by providing a first loss tranche that will ensure that investors can meet their capital requirements while investing in sustainable infrastructure. So again, these are just some examples, and in the lead up to COP26, more blended finance initiatives have been proposed that can offer more such innovative solutions to mobilize private capital.
Absolutely. And while we're only able to cover a few topics during our brief chat here today, it's clear that multiple solutions involving a diverse range of stakeholders will be needed to crowd in institutional investments into sustainable infrastructure. The COVID pandemic is a test of global resilience, and infrastructure is at the core of a society's ability to absorb shocks. However, with government debt levels having increased substantially during the pandemic relative to pre-pandemic levels, private capital must be mobilized for investments into sustainable infrastructure assets, especially in emerging markets where the investment gap remains very high. So it was a pleasure being here. Thank you, Carmel, for doing this. And I hope that this was an insightful discussion, and we invite you to go check out the report for more information.
Thank you very much.